Risk management in futures and options trading, FO trading, is crucial for traders to protect their capital and navigate the inherent volatility of these markets. Here are some key principles and strategies involved in risk management for FO trading. Position sizing. Determine the appropriate size for each trade based on your account size, risk tolerance, and the volatility of the market. Avoid risking too much of your capital on any single trade. Stop-loss orders. Implement stop-loss orders to limit potential losses on each trade. These orders automatically trigger a market order to close your position if the price moves against you beyond a certain predefined level. Diversification. Spread your risk across different asset classes, markets, or trading strategies. Diversification can help mitigate the impact of adverse events in any single position. Risk-reward ratio. Assess the potential risk and reward of each trade before entering. Aim for trades with a favorable risk-reward ratio, where the potential reward outweighs the potential risk. Risk assessment. Conduct thorough analysis of market conditions, including fundamental factors, technical indicators, and sentiment analysis, to assess the potential risks associated with each trade. Margin management. Understand and manage your margin requirements effectively. Margin is the collateral required to open and maintain positions in futures and options trading. Be aware of margin calls and ensure you have sufficient funds to meet them. Hedging. Use hedging strategies to offset potential losses in one position with gains in another. For example, if you have a long position in a commodity futures contract, you could hedge your risk by taking a short position in a correlated asset or using options contracts. Risk control techniques. Explore advanced risk control techniques such as option spreads, straddles, and strangles to limit downside risk while still allowing for profit potential in volatile markets. Continuous monitoring and adjustment. Regularly monitor your positions and the overall market conditions. Be prepared to adjust your risk management strategies as market dynamics change. Emotional discipline. Control your emotions and adhere to your risk management plan, even in the face of market fluctuations or unexpected events. Avoid making impulsive decisions that could jeopardize your trading capital. By implementing these risk management principles and strategies, FO traders can strive to protect their capital and improve their long-term trading performance,